Hey everyone, and welcome to This Explainer. Today, we're putting on our professional equity analyst hats to conduct a really rigorous, no-holds-barred stock valuation. We're looking at Cogent Biosciences. We're going to take their latest financial metrics, run them through traditional absolute, relative, and asset-based valuation models, and see if we can calculate the stock's actual intrinsic value. Get ready, because what the data reveals here is, well, it's nothing short of fascinating. Right off the bat, let's look at a number that's practically guaranteed to turn heads. 550.62%. That's Cogent Biosciences' trailing 12-month return. And over a 5-year period, the stock has posted a cumulative return of over 310%. So by all outward market indicators, this stock is just on absolute fire. But, as analysts, we can't just look at price momentum, right? We've really got to look under the hood. Okay, let's dive into this because here's where the story gets pretty wild. On one hand, the market currently values Cogent at a staggering $5.979 billion. Massive, right? But on the other hand, their trailing 12-month revenue is exactly $0. Not a million, not 1,000, literally zero. So the big question is, how on earth do we value a nearly $6 billion company that technically doesn't sell anything yet? Section 1, the Sea of Negatives, Profitability Check. To figure out this valuation puzzle, we have to look for traditional signs of cash generation. But when we actually crack open the income and cash flow statements, we're met with a staggering volume of negative fundamentals. Trailing 12-month net income sitting at negative $277.7 million. Free cash flow is just bleeding out at negative $265.9 million. And the thing is, absolute valuation models, like your discounted cash flow or residual income, they rely entirely on these numbers being positive, or at least having some clear, predictable path to becoming positive. Just look closely at the return on invested capital, or ROIC. It's sitting at negative 136.61%. To put that into perspective, for every single dollar this company invests into its operations, it is deeply, profoundly bleeding money. Now, for a traditional business, this would signal an immediate death spiral, no doubt about it. But in the pre-revenue biotech space, it's kind of just a harsh yet somewhat expected reality of research and development. Section 2, Balance Sheet Lifeline, Surviving the Burn. So here's the billion-dollar question. If they make absolutely no money, generate zero revenue, and burn through hundreds of millions of dollars a year, how are they not bankrupt? How are the lights still on? Well, the answer lies hidden in their balance sheet. And to understand it, we need to define an asset-based metric called the current ratio. Basically, this is a strict liquidity ratio. It measures a company's ability to pay its short-term obligations, anything due within the next year, using only its most liquid current assets. Get this. Cogent's current ratio is a jaw-dropping 14.23. Just to give you a baseline, a healthy ratio for a normal company is usually somewhere between 1.5 and 2. So a ratio of over 14, that means Cogent is sitting on an absolute mountain of short-term cash and liquid assets. They have more than 14 times the cash they need to cover their near-term liabilities. This is quite literally their survival mechanism. And this brilliantly illustrates their overall capitalization strategy. Check out their debt-to-equity ratio. It's incredibly low, just 0.35. Their lifeline isn't being funded by taking on heavy, burdensome debt that requires interest payments. Instead, it's funded by massive liquidity. This is likely raised through equity offerings, allowing them to push forward with clinical trials without the immediate terrifying threat of insolvency hanging over their heads. Section 3, Why Traditional Valuation Fails. Models Breakdown. As professional equity analysts, we're tasked with finding the intrinsic value of this stock using standard absolute and relative models. But this is where we literally hit a mathematical wall. Methodically breaking down these absolute valuation models reveals the core issue. First, the dividend discount model. It requires finding the present value of expected future dividends. Since their dividends are zero, this model completely fails. Next, the gold standard, the discounted cash flow, or DCF. A DCF projects free cash flows and discounts them back to the present, but their current free cash flows are at negative $265 million. Even if we plug in a standard weighted average cost of capital and assume a standard 2 to 3% terminal growth rate, applying those inputs to deeply negative cash flow gives us a mathematically undefined negative intrinsic value. Oh, and the residual income model also fails because it relies on a positive net income, which, as we saw, is deeply in the red. Okay, so what about relative valuation models? Comparing them to peers, maybe? Well, the absurdity kind of just continues. Their price-to-earnings ratio is negative 17.12. Their forward PE is 0. Their price-to-sales ratio is 0 because, think about the math here, dividing a nearly $6 billion market cap by $0 in revenue literally gives you an error code. We simply cannot derive an implied share price from any of these metrics. And the exact same thing goes for enterprise value multiples. EV to EBITDA is negative 16.02. EV to EBITDA is negative 15.90. These models are supposed to compare a company's total value, adjusted for cash and debt, to its operational cash flow. But when earnings before interest, taxes, depreciation, and amortization simply don't exist, these relative metrics offer us absolutely zero help. The data leaves us with completely nonsensical per-share outputs. Really, the closest thing we have to an asset-based valuation metric that actually functions here is the price-to-book, or PB ratio. That currently sits at 9.27. If we look at net asset value, the market is essentially valuing Cogent Biosciences at over 9 times the underlying book value of its actual assets. This massive premium tells us something very, very important about the overall investor psychology when it comes to this stock. Section 4, the final analyst verdict, valuation synthesis. So we've run the numbers, we've attempted all the models, and now we've got to summarize our intrinsic value range based purely on the reported financial data. And the crucial point is this. According to the source data, the intrinsic value, the margin of safety, and the fair value price are literally just NA, not applicable. We have this massive discrepancy. Our models output a fair value of practically 0 based on current operations, yet the stock has a $6 billion market cap. Why? Because early-stage biotech valuations completely break the traditional rules of finance. They trade entirely on the speculative future value of unapproved pipeline assets and potential clinical trial results, not on present-day cash flows. The data shows us a company with massive market momentum and incredible liquidity, but absolutely zero operational profits. It really forces us to step back from our spreadsheets and ask a fundamental question about investing in the pre-revenue biotech space. When you invest in a $6 billion company with 0 revenue, are you actually buying a traditional business, or are you essentially buying a highly educated lottery ticket? Definitely something to think about. Thanks so much for joining me on this explainer, and remember, always keep questioning the numbers.